Welcome, investors. The Iran-Israel conflict intensifies. They just started shooting missiles at each other. What does that mean for interest rates? And it's likely not what you expect. Retail sales data release doubling expectation. What does that mean for you, and why is that important? Let's dive into it. All right, let's first get on to this Iran-Israel conflict. We're not going to talk about the politics of it. We're just going to talk about how it affects the markets. You can see energy prices, crude oil prices are starting to shoot up, starting to explode up to a $85 a barrel range, and generally it floats around $60 a barrel. That way the energy companies can make money. So it's 20 to 25% higher than its range typically. So that is going to cost pressure for the consumers, pressure for businesses. And how does crude oil translate to pressure of consumers and businesses? Crude oil prices are upstream of gasoline prices. So if crude oil prices are higher, you better believe gas prices will be higher. Also, natural gas prices could end up being higher. It's going to have a downstream effect of a lot of different energy prices, which is transportation. You got to fill up your car, your transportation boats. So it can cause a lot of damage and cause a lot of problems to the economy. Next thing I want to move on to is interest rates. If oil prices are high, right, we're having more inflation into the economy because things are more expensive to transport goods, more costly, more expensive. That has to be passed down to the consumer. So if energy prices are high, does the Fed have to raise interest rates to bring down that inflationary pressures, to bring down that energy prices? Well, unfortunately, the Feds probably can't really tilt the scale on energy prices going up, going down. It's not really controlled by them. Can they have some kind of effect? Yeah, maybe that's debated. But I want to talk about, okay, if crude oil prices going up, what are energy prices going, or what are interest rates going to do? Let's take a look. All right, so I got the history of crude oil prices starting from the early 80s. And let's discuss a little after 2006, 2007. So we got April. I'm going to give you guys an example here. You got April 2007. Energy prices shot up all the way topping to June 2008. So what happened to interest rates during that time? And let's use the 30-year fixed mortgage. Interest rates, the 10-year, the 2-year, Fed funds rate, they're all pretty correlated. So let's take a look. Let's find that April time period and see what happens. Yeah, interest rates went up just a little bit here, 0.5%, but really started trending down, and a little spike in early 2008, mid-2008, but again, starting to trend down again. So the trend was down when we had energy prices shooting up because it had damage to the economy. Let's look at a different time frame. October 2010 started shooting up really high above that 83, 85 range. It's quite a bit higher than normal. We ended June 2014, so going into 2014, end of 2010 and 14. What happened to rates? October 2010 shot up a little bit, 20.25%, but really just trended down during that whole time frame. So, all the way up until 2013 had a little spike, but again, started trending down into 2014. All right, so what's that telling us? Just because energy prices are high doesn't mean interest rates are going to go up at the same, because energy prices causes damage to the economy. People can't afford it. They slow down transportation, they slow down traveling, they slow down their purchases because things become too expensive, thereby forcing interest rate down. So it's kind of counterintuitive. So just because we see this escalation in Iran-Israel conflict, interest rates may not go up, but you can better believe we're going to feel it as consumers and as an economy. All right, so let's shift gears into retail sales. We had a double than expected number. What in the world is retail sales and why it's so important? Let's take a look. What the retail sales number and how it all really operates. So it all starts with your manufacturers who are going to build your stoves, your washers, dishwashers, or your washer, dryer. They're going to sell them to the wholesalers. And then the wholesalers are going to transport them to the retailers, which are your Walmarts, your Targets, your mom and pop shops, who sell to us, the consumers. You going to the Target, going to Walmart, purchasing from the retailers. That is the retail sales numbers. Without the consumer, you don't have the retailer, you don't have the wholesaler, you don't have the manufacturer. So we need the consumer to keep things going. We need the consumer spending for everyone to be making money and healthy. All right, so you can clearly see without the consumer, without them going to purchase goods from the retailer, there's no wholesaler. But sometimes the retailer and wholesaler are the one and the same. Sometimes Amazon acts as the wholesaler and the retailer. But anyways, the retailer doesn't exist without the consumer. The wholesaler doesn't exist without the consumer and the retailer. And the manufacturer doesn't exist without the other parties all involved. But it all ends with the consumer, and that's what we get that retail sales number. So let's take a look at what that number said. And is it really as strong as we're being told it is? Market Watch data calendar here, just giving us the data. In this column, the medium forecast, the analyst, economists, what they expect, and the actual in that column. So let's look at retail sales. Expectation from Feb to March, 0.3, and we got 0.7. So again, double that expectation. So what do I mean by being so strong? Are the consumers, are they using their savings, their cash, or are they using debt? And debt can cause problems. If you're a strong consumer, why are you racking up debt? So let's look at really since 2021, consumer credit card debt, the revolving debt is shooting up. We're over $1 trillion. And then we had, in 2020, when we get recessions, revolving debt goes down. Let's look at a wider chart. And is it really as explosive or healing this credit card debt? I mean, we've been an economy that's been building up debt over the past 30, 40 years. And then again, we had a recession here in 2008 and it drops off, but we're getting on that path again of just racking up credit card debt. But there's something a little bit different there's something different now compared to the last 20 years. And right now we are paying this ultra high credit card debt at 30-year high interest rates. And that is going to have ramifications. You're paying more money to pay, you're paying a higher interest rate for that debt, and that adds up. That causes more pressure. It causes your monthly credit card payment to be higher because the interest rates are higher. So the question is that we need to answer, and we're going to figure out over the next year, is these high interest rates with this really high amount of debt, are consumers going to be able to handle it? Can they handle these high interest rates? Because the Fed has told us they're going to keep rates higher for longer because they're not seeing the numbers they want to see in inflation. So what are they going to wait for? The inflation's not coming down right away. So they're going to look for weakness in the economy to cut rates. Weakness for consumers, weakness in the job market. So can the consumer service this debt where it is? If we can, we avoid a recession, we're good. Or does the high interest rates, the high debt break the consumer, therefore bringing down the economy for a period of time, maybe 6 months, year, 10 months. Time will only tell. So stick with us, and we'll talk about some more inflation data being released next week. Expertise you deserve, experience you can count on.